Tuesday, December 8th, 2020, Maneco 64, home of alternative economics and contrarian views. Before I start today, I'd just like to show you this mug that I designed. It says, only physical gold and silver will slay the bullion banks. And why is that? Well, because they hate the general public buying physical gold. Even the World Gold Council does as well. They push ETFs, really, which is not real physical gold. It only tracks the price of gold. So there you go. I've got David and Goliath there. Of course, Weird David trying to slay the bullion banks. And it says maneco 64 here as well. There's a lot of nice Billy mugs as well there, or End the Fed mugs and the ECB mugs. I used to have an End the Bank of England mug, or Close the Bank's Doors mug. I'll have to design another one of those for the Bank of England, because I had a picture there that I bought the rights for about a year. Those rights are finished, so I can't sell them anymore. So I have to design something for the Bank of England. So just have a sip of my coffee before I start today. So yesterday, gold broke out a very key technical level. And I think we're now back to going a lot higher in gold. It's my opinion. And I guess it will help those of you who trade. And maybe for those of you who hold precious metals as insurance, as a way of storing your wealth long-term, in order to keep the purchasing power of your savings, it might give you a bit more peace of mind that the shenanigans in the paper market, they're over for now. They will happen again, unfortunately. But I think the bullion banks are going to have a tougher time doing it. And that's why I think we need to keep stacking, because they don't like that. And they try to discourage people to do that. Yes, we saw how in the last month of November, when they had their options expiry on COMEX. And don't forget as well, there's a lot of option trading going on in the over-the-counter market, in the physical market. So it's not just COMEX, but it's also the OTC market, which is huge in London. And then you had also the beginning of the delivery starting now in December. And we've seen since the beginning of December, gold has just zoomed right back up. It's traded up over $100 from that engineered move lower. And yesterday I tweeted out when gold was around 1846. It was about 17 hours ago, and I said XAU-USD testing key resistance level that had been key support from the end of September at 1848. So yeah, it was the break of that level actually back in the end of November, the 1848 level, which had been the low since the correction from the all-time high. That low had held, and it was when it broke that level that we saw gold drop almost back to like 1760. So I knew that breaking above that 1848 level would probably trigger a lot of stops, short covering, because that level is so important. And lo and behold, gold did that yesterday. So I think gold is looking a lot better. Silver, I'm going to look into that as well, and show you a couple of charts that I think are very interesting. So let's start with that right now, and then we'll look at the markets. But let's start with gold, of course. Yes, as I said, that level was really key. And as you can see here, after we broke that level, gold spiked all the way up to almost 1870. So I think right now gold is looking pretty good. Of course, there are some key levels that we still have as resistance. I think like 1963.65, which is a recent high there in the beginning of November. That will be key as well. Of course, 1900 as a round figure. So let's look at silver. So this is a longer term chart of silver for this year. with the low below 12 there in March at 1133, the classic bear trap, and then the move up to almost 30 by the beginning of August. And I've done Fibonacci retracement, and you can see here that silver's pretty much held the 38.2% retracement. That's the golden mean, Fibonacci golden mean. Yeah, we went through that level a couple of times, but for a very short period of time. And right now, I think really the key technical level for silver is really around 26, because it's the recent high from the beginning of November. If we break through that 26 level, yeah, hold on to your silver bull, I would say. And then shorter term, I'll show you another chart of silver. This has got the Fibonacci retracement for the correction from the level near 30. As you can see here, the 50% retracement of this correction we've had since the beginning of August comes in just below 26 at 25.77. So that's why I think those two levels there are really key for silver. Just below 26 and at 26. I know we're nowhere near there for now, but it could move in the day. We've seen how silver has moved this year, so I wouldn't be concerned. Before I look at the markets this morning to see where we are, just wanted to touch upon this story about student debt. The supposed Biden administration to be is talking about forgiving or canceling student debt. One thing I would say is that you really need to read between the lines on this, because I listened to Catherine Austin Fitts, and she said, yes, they might cancel some of the debt for students, but they're not gonna like destroy that debt. It's gonna be put probably on the balance sheet of guess who? Your great Uncle Sam. He's gonna take it on. So I'm not sure if that's going to happen, but you need to keep an eye on that, because all it will mean is it's going to be transferring that debt basically back to everyone, to all taxpayers, including those people that are supposed to be forgiven of it. And it will even lumber these people's children and grandchildren with it. So there's a lot of talk about it. I think Biden said he was going to cancel $10,000 per student. Now there's talk about 50,000. Well, what's another 40,000? Why not cancel the whole thing and put everything on Uncle Sam's balance sheet? Have the Fed also print the money to help Uncle Sam with the new debt, right? It can be done. It's so easy these days to create money or reserves out of thin air. And that's another reason why you should not be fooled by all this political grandstanding about student debt. So this is like the typical, you create the problem, there's a reaction to it, and then the solution, you give the solution yourself. So it's not only in the US, they've been pushing this here in the UK as well, making it really easy for young people to get student debt to go to university, even if they might have been better off not doing it, getting lumbered with that, and now they can't get jobs, and there's a problem. And now the solution is to transfer the debt onto the balance sheet of the sovereign or Uncle Sam. But I'd be surprised if they cancel it altogether and don't put it on Uncle Sam's balance sheet, because that would mean someone losing out. Mrs. Rothschild, Mrs. Rockefeller, they would be losing out. You'd be losing out as well, because a lot of 401ks, pension schemes, they probably invested in these Sallie Mae bonds. That's what they're called, I think, the student debt bonds, Sallie Mae. So there you go. That's what I wanted to talk about. I still think the debt is the 500 pound gorilla. You know, it's the bull in the China shop, so to speak. It's the big problem of our time, and we're addicted to it. Not you and I, hopefully, but in general, the public is. I heard someone comment in the, or saw someone comment in the live stream on Sunday that someone said now that national debt is not a problem. Governments and states can indebt themselves. It's not a problem. The bad debt is a personal debt. Yeah, that's the Keynesian paradigm fallacy, right? If that isn't good for us as an individual, it shouldn't be good for the government or the state, because it's a collection of individuals that the state represents, right? And we're going to have to be paying for that debt in the end of the day. So there you go. So let's look at the markets then this morning. Do I have projections for gold and silver? A lot of people want to ask me, oh, what do you think? Where do you think gold and silver are going to be at the end of the year? Well, your guess is as good as mine, but last year I would have said, you know, next year, 2020, gold will be a lot higher because the central banks are going to keep inflating. And this was even before COVID, because the repo market went into crisis in September of 19. The Fed reversed everything, all its policy that it had started in 2017 by raising rates, and then in 2018 by unwinding the balance sheet. Jay Powell saw that that was going to be a disaster. He had to unwind everything. So I said, yeah, gold will be higher because the dollar will be lower. So all I can tell you is that, in my opinion, in 2021, gold and silver will be higher, but it's more going to be a case of the dollar and all other fiat currencies are going to be lower. So yeah, I'd love to know where gold would be on December 31st, but I don't know. Anyway, it's 8:37 a.m. London. So we've got spot gold at 1866, up about $4. The high has been 1872. So yeah, we had that burst up yesterday when we broke that 1848 level. And those people who don't really trust technical analysis, well, technical analysis work very well there if you're a short-term paper trader in gold, which I used to do many, many years ago, but I don't bother anymore because you need to keep an eye on this like every second, every minute, and that's not what I'm doing these days. But I could tell back in the day when I did trade some gold futures, and that's over 10 years ago, I would have bought the breakout of 1848 and probably have gotten out yesterday 10 or 15 minutes later at maybe 1855 or 60, even if it went even further. But it would have been a really good trade that there was a very good chance that you would make money on. Of course, it could have failed the break of 1848. And if it failed, you just try to get out as quickly as possible. That's what I used to do. But anyway, enough of the trading strategies. So the range has been, 1872 to 1858. So now for the traders out there, that 1848, 1850, that will be key support. Silver did really well yesterday. Later on, it went up to like 2480. But then it just like lost a lot of steam, as it does sometimes. This morning, though, it's up 18 cents or 0.75%, so outperforming gold. We're at 24.65. Range has been 24.44 to 24.77. So I think 24.80 right now is resistance. Yes, we're still far away from 26, but we could be there later on today. That's how silver could move. The Dow future is just below 30,000. It's at 92, so eight points below that figure. We're down 75. S&P is down 11. NASDAQ is down 16, an eighth of a percent. I just wanted to before I look at the currencies, I saw a tweet this morning from a guy called Charlie Bilello, and he noted that the Tesla market cap is $609 billion. And then he compared it to all the other major automobile makers. So he had Volkswagen, Audi, Daimler, GM, BMW, Ferrari, Honda, Ford, Fiat Chrysler, Peugeot, Porsche. Those makers combined their market cap 589 billion. Does it make sense? I don't think so. But I guess markets can remain irrational for longer than they can remain solvent. I know a lot of people have tried to short Tesla with not much success. But anyway, fiat currencies, the pound is continuing to weaken. This Brexit negotiation is still ongoing. Boris Johnson now is going to Brussels to try to solve it. I don't know what's going to happen. I think the people who voted to leave the EU, they're going to get screwed as usual. If voting mattered, it would be illegal, right? As someone said. So sterling is continuing to go lower here. It's down 1/3%, 133.39. We've got the euro unchanged virtually, 121.15. Dollars unchanged versus the yen at 104.07. And dollars approaching 650 in the yuan. We're at 650.184. WTI crude is down 1/3% at 45.71. Yet high grade copper has come off a little bit here. We are down 2/3% at 349. Just have a look at the chart, but it's still looking very positive. We might have a bit of a correction in high grade copper for now. So to finish off here, let's look at the 10-year yield. Well, it's at 0.92, so it's down about 2 basis points since my video yesterday. It was at 0.94. I really think they're watching that 1% level. I think we've been near there a couple of times in the last month or so. More recently, I think it was last week, we got right near that 1%. And I don't think the Fed can afford to allow yields to go that much higher, maybe to 125. But we saw back in 2018 when we got to 3.25. That's when everything started hitting the fan in terms of the stock market. That was the beginning of the end of Jay Powell's attempt to normalize policy, which eventually led to the reversal in 2019, cutting rates in 2020, unwinding his quantitative tightening and doing more QE, right? So yeah, I'll keep an eye on the 10-year yield and the bond markets because I think, yes, they're extending the bull market in bonds, the bear market in yields, much longer than it would have naturally have been through manipulating rates through QE. I think the bond bull market from 1920 to 1954, well, that was 34 years. We're about 39 years into this bull market. Ever since the 10-year yield hit around 16% back in 1981. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And if you do, make sure you hit that little notification bell. I make a video every day. And if you enjoy my videos, you don't want to miss them, right? And I wish you all a great day as well. Take care. Bye.